Hello, I'm Jasmine Birtles, and this is the Tin Hat Money podcast. Today, I'm speaking to Clive Thompson, who is a retired wealth manager with 47 years of experience in the business. He now lives in Switzerland, and he says that I can give you his LinkedIn page and he'll answer any questions you have after seeing this podcast. So check the link below. And of course, check the link to MoneyMagpie.com, which is my website, which will also give you all sorts of answers to all kinds of questions. So, Clive, I asked you to come along because you and I have been talking in particular recently about government debt, which is a continuous theme around the West, particularly.
The way we typically measure government debt is what's known as debt to GDP levels. That's the ratio of the amount of debt the government's got compared with the total economy. So if I was to put that into a family context, and obviously the government's not the family, we'll talk about the differences in a bit, but if this was a family, you'd be looking at the level of credit card debt you've got, for example, compared with your monthly income or your annual income. And the higher your credit card debt is, the higher your debt to income ratio is. So governments are not looking at the level of income they're collecting, which is the taxes they're collecting. They look at the total economy, everything that you and I earn and everybody else earns, and what the level of debt is relative to that. And you probably would think that the level of debt shouldn't be particularly high relative to what the whole country earns, but across the board it currently is. But if we just go back a little bit in time, back in the 1980s, most countries had manageable levels of debt, and I've got them here in front of me. For example, in the Eurozone, I'm looking at 1983. The reason I'm looking back there, it was about a decade after we'd gone off the gold standard, and governments were starting to get a bit lax with their spending. In other words, they were no longer constrained by the fact that everything had to be backed by gold. Back in 83, the Eurozone had a debt to GDP ratio of 37%. Now, just to paint a picture, that is perfectly acceptable as a level of debt to GDP.
Yeah, that's decent. Gosh, I haven't heard that figure for a while.
Yeah, the UK, same year, 83, had a debt to GDP ratio of 43%, a little bit higher than the European average. Japan had a debt to GDP ratio of 36%, about the same as Europe. And the USA had a debt to GDP ratio of also 36%. So all the major economies were clustered around this sort of 36, 40% level, which was a fairly acceptable level. Now, by 1992, the European Union was coming into existence. It came into existence via the Maastricht Treaty, and under the Maastricht Treaty, which was signed on the 7th of February 1992, one of the provisions of the Maastricht Treaty was to be part of Europe and to eventually be part of the Eurozone. That's the zone where we use euros. You had to have a debt to GDP ratio of less than 60%. Now, that was quite an easy number to achieve because by 1992, UK was at 37%, France 39%, Germany 41%, Spain 48%, all well below that 60% debt to GDP threshold. There were a couple of countries which were joining the EU which were above that level, notably Italy, which was higher, and Greece, which was higher. But at least they had a plan and an agreement, in fact, that they would bring their debt level down to below the Maastricht requirement of 60%. The USA was also below 60% at the time, and so was Japan. No, actually, Japan was slightly higher at the time at 68%. But now we step forward to about 2003, and many countries had surpassed the 60% level, except the UK was still below that. Go forward to 2013, another decade on, and we'd had the global financial crisis of 2008. Now, if you remember, the global financial crisis was when all the banks around the world went bust because they'd all bought derivatives on American mortgages from which were basically loans to people who couldn't afford to pay them in America. And the problem was these loans were defaulting left, right, and center. And the banks had these as assets, and their capital was being wiped out as these loans defaulted. So what did the governments do? They bailed out the banks to save the banking system. And that meant pumping a lot, basically borrowing a lot of money, increased the debt levels, and pumping a lot of money into the banks as capital, share capital, basically increasing the government's debt, but not really increasing the GDP. It just saved the GDP from collapsing, which was a good thing, because had the GDP collapsed, we would have had civil war on our hands all around Europe, because nobody would have any jobs. So it'd be like a Great Depression, and that was the aim, to avoid it. But the result of that, if we step forward to, I'm looking at 2013, a few years after 2008, every country, every major economy had a debt to GDP ratio now well above that 60% level, which was widely regarded by economists as the maximum countries could sustain without damaging their economies. So by then we were in Europe, we were sort of knocking on the 90%, UK 85%. Japan had soared to over 200%, and the USA was about 100% debt to GDP. All of those numbers well above what was sustainable. And we're talking here 10 years ago.
Well, because it's even higher now, isn't it? Something like 110% for the UK and 260% for Japan's, which is beyond my comprehension, frankly.
If I take the sort of official numbers, which are generally talked about, in the Eurozone, we're coming up to, we're 93% now, debt to GDP ratio average. That means plenty of countries are well over 100%. UK is officially, as of 2023, 98%, but everybody knows that's going to be over 100% this year. And Japan is, as you said, 264%, and the USA 121%. So you see, quite a few countries are, or all countries are more than 50% above the maximum sustainable level, and some countries are double or five times the maximum sustainable level. So we're really in deep dodo, and the question is, how long can this carry on before it goes wrong or it goes fut, and then what happens?
Well, yes, that I think anybody would. Well, just before we go into that, one question that I have, which I'm often asked, is who are we borrowing this from? Because, as you say, some of it we're kind of lending to ourselves, and we're just creating our own bonds. We're printing money, really. But are there big creditors, like, for example, China? Are we all basically indebted to China?
The biggest borrowers are countries like China and like Japan, although they don't hold as much foreign reserves, at least not in the form of US government reserves, treasuries, as they used to. They're kind of reducing those a little bit for the same reasons which I'm describing, i.e., the higher the debt goes, the more worried about what its value will eventually be if and when they ever get repaid.
So they're the biggest lenders, you're saying. So China,
they're the biggest lenders.
Biggest lenders, yeah. Right? Yes.
They're lending to the United States and to some extent Europe and Britain. They buy the gilt-edged securities in the UK. They buy the treasuries from America, and they buy the European government bonds from the ECB or from specific countries in Europe.
But as you say, I mean, if we go back to the sort of personal borrowing, personal debt levels, if I were lending to somebody who was continuously borrowing more, and then I got to find out that they're actually spending more than they earn, and they're keeping on spending more than they earn, I would be worried about lending more to them. So that's the situation now with China, Japan, etc. They're looking at it and thinking, ooh, not sure.
Exactly the point. You get to a point where you say, this person hasn't got his finances under control. There comes a point where I'm not going to lend him anymore because I'm not going to get it back. Now, of course, in the government's case, it's different from an individual because everybody thinks that sovereign countries like Japan, like the UK, like the USA, we all think they can print their own money. So we are going to get it back, at least so we think, because they're going to print it and pay us off with newly printed dollars, newly printed pounds. But of course, what are those newly printed pounds going to be worth when eventually we get repaid? There's going to be a lot more of them around, and therefore it's likely they'll be worth a lot less.
Yes.
So that's the concern. The concern is that the fact that the debt itself is growing wouldn't be a problem if the GDP, the gross domestic product of the country, was growing at just the same speed. That's not really a big problem. The problem is when the debt is growing much faster than the gross domestic product. And that is what's happening all around the world now, at least in the major economies. And the question, which we don't really know for sure what the answer is how long can this continue before it spirals out of control? And I'm just going to go sort of touch on a couple of ways it spirals out of control. What is the level of interest that governments are paying on the debt? Now, one of the big saviors of that we had out of the 2008 financial crisis was it allowed governments to lower interest rates to, in many countries, negative rates or zero. And what that meant was that it wasn't actually costing the government very much at all to service the national debt. But where we are now is that interest rates are no longer at zero. They're rising. They have risen. For example, the United States, which for many, many years, a decade or more, had interest rates of 0.25% after the global financial crisis, their rates are now 5.4% at the short end. And if you're buying a 10-year bond, it's currently 4.4%. That's the current rate. What that means is as the debt that the government borrowed 5 or 10 years ago at these very low rates starts to mature, they have to refinance it because they can't pay it back. They don't have the money. They have to refinance it at the new higher rates. And those new higher rates are 2 or 3 times what they were paying before. So what does that mean? It means that the amount that the government is spending servicing the debt, i.e. paying the interest, is rising and will continue to rise over the coming decade rapidly compared with the tax take they're getting. So whereas today, if I take the USA as an example, they're spending about 14% of their tax take on servicing the interest on the national debt. In the current year, that's likely to be something like 30% higher. It's going to be 18 or 20%. And the year after, it's going to be in the high 20s. So within a decade from now, it's quite likely in the United States, and I'm using that as an example because the data is more readily available, it's quite likely that we'll reach a point where 100% of the tax take is being used to pay the interest on the government's debt. Can that continue? Well,
No.
Yes and no. I mean, it depends who plays ball. If the Federal Reserve, and by the way, Federal Reserve is not the government, the Federal Reserve is the central bank of the United States. They're the ones who print the money because the United States did. So the Federal Reserve prints a lot of money to lend to the government. Of course, the game can continue for a while. The debt can keep going up and up, and they can keep paying the interest with the money that the Federal Reserve has just printed for them. But of course, the debt is getting bigger at a faster and faster pace. The Federal Reserve's balance sheet is getting bigger at a faster and faster pace. And people on the planet, in dollar terms or pound terms or whatever country we care to look at, are getting richer because the government's getting poorer. So at some point, this could lead to a general distrust of the currency, i.e., wealthy people, those who are the major holders of government debt or the major holders of cash deposits, start to say, I don't really feel comfortable holding this because everybody else is buying things which are going up in price, whether it be houses or shares or gold or Bitcoin or whatever it happens to be. They're buying stuff and it's all going up in value. And I'm holding these lousy deposits, paying a measly 5, 6, 7, whatever, 10% even. They won't be happy with that by then. Paying a measly interest rate and paying tax on it. I'd rather earn some other things. So people start to take their money out of the currency and try and buy other things. But then you get into a bit of a race. Who's going to be the last man out? Because when you buy something, somebody else is selling it. Then they're saying, "Oh God, I've got all this cash. What do I do?" And that's basically a currency panic. There's not one clear answer as to how it ends up.
Mm.
There are multiple scenarios which will depend on a lot of things, and there are scenarios which will play out slowly and scenarios which will play out suddenly without warning. But in every scenario, if you happen to be holding a large cash balance or money market fund or deposit, or you're an investor in bonds, you'll probably find that you are a bag holder holding an asset which is not buying and is not worth as much as other things.
I and various people I know are kind of already thinking like this. We're already moving money away from cash, and certainly, I mean, I wouldn't touch bonds, haven't done for a while, and I'm moving quite a bit of money into gold, and certain shares. As you say, to be honest, you know, you have to be careful with the shares, but gold, Bitcoin, as you say, assets. Are you finding this already from people you know, maybe former clients, etc.?
The message that I'm giving you here is now being shouted from the rooftops by those in the know. If you go back a decade ago, people weren't saying much. There were a few out there who would say these sort of things, and I wasn't on YouTube at all back then, so I was saying it to my clients. But now we have, you know, the mass media, and everybody can be a mouthpiece, and you only have to look at YouTube, and you will find hundreds of people sending out that message, including some very important people on this planet, such as Jamie Dimon, the head of the largest bank in the world, such as Jerome Powell, the head of the Federal Reserve. Even he, and you know, you'd think he might have to toe the government's line, but even he says he is extremely concerned by the level of government debt.
And before we go into what people can do to protect their money, I'm just wondering about why we have such levels of debt. Because, you know, if we go back to the person with a credit card, I might be looking at them and saying, he's just bought a Ferrari. Or I might be looking at him and saying, oh gosh, he's having to spend on living. He's got an expensive house and it's just getting more expensive. Maybe he should sell the house, you know, these sort of things. So what are we really looking at for the America, Britain, Europe, Japan? Is it that we're all spending too much on defense, or is it that it's the pensions, state pensions, and the NHS, all of those things that are meaning that we're spending more than we earn?
It's not, obviously defense is a factor, but it's not really the big factor at the moment. We're not really at war, not in the sense of the wars we had 100 years ago, but it is a factor. But the real problem is the parachute society we live in, and we all are entitled to be protected against starvation, protected against illnesses, and so forth. It's, you know, a fundamental human right that we should have some sort of parachute. But the trouble is, it's a system where if that parachute exists, a certain percentage will be less productive than they might otherwise be. Services like Medicare in America, social services, are consuming something like 2/3 of what the government spends. So that doesn't leave a lot for other things, like spending on infrastructure and other things. So you've probably got another 1/6, roughly, going on national defense. So there's a limit to how much you can cut that. But it wouldn't really make a great deal of difference. And the other 1/6 is on a variety of different projects that the government might have here, there, and everywhere, different kinds of things, including paying the salaries of the civil service and God knows what else.
Yeah.
So there's not a great deal of flexibility to reduce the spending, to be honest. Not unless you want a revolution on your hands. Raising taxes is not a brilliant idea, because when you raise taxes, it does actually slow the economy. People become less willing to invest and less likely to invest and less likely to take the chance. They become more, well, I'll take what the government gives me, but why should I gamble it? You know, why should I risk losing it in a business venture? Now, the economies which are doing very well are those which don't have any parachute system. And those countries, to a much larger extent, rely on family ties to look after the less fortunate. You know, if your parents are retired in many countries, the government's not giving them any money. It's expected and required almost that the children take care of their parents, and it's traditional, and it's everybody thinks that's the way they should behave in those countries. But that's not where we've got to at the moment here in the West. You know, if you get to retirement, you get your pension, and it should be enough to survive on. And your kids don't usually, often, well, I say usually, in many cases, don't bother to put their hand in their pocket to help their parents out.
No, right.
So yeah.
What do you feel then is the thing that we ordinary people should do to protect our wealth? A lot of people don't think of themselves as wealthy, but you know, just your wealth or your money, the money you have. How do we protect it against the evil day that you're describing when things go fut?
Well, first of all, if you're the man in the street, and that will be about 80% of the population, with an average job, you're earning an average income, and you're spending more or less most of what you've got, and you might even have credit card debt on top and suddenly got a mortgage. You really don't have to worry too much, because you won't have very much in the way of savings, and it's not being eroded by the constant printing of money. So as this constant printing of money goes on, you can reasonably expect your salary to go up as the company you're working for is making more money and can afford more, because the money's out there, it exists. As I said, the end of the system we're in could come to an end very, very slowly, perhaps through gradually rising inflation levels, or it could come very suddenly due to what's known as a currency reset, or it could come due to some sort of, I say it's not the end, but there could be some restrictions like government bail-ins where they require large holders of cash balances to invest in government bonds. There's a lot of scenarios out there, but if you're just the man in the street, you're not likely to be affected by these negative scenarios very much. So you could just carry on as before. But if you got some savings, and by savings I mean a lot more than the average person, then if those savings are in the form of cash or bonds or money market funds or deposits, when the end comes, you're likely to be the bag holder. You're going to be holding something which isn't worth very much and maybe worth nothing.
Essentially, assets, you're saying collectibles, sort of solid things that you can hold. Because of inflation, it's going to go up. So if we buy collectibles, gold and silver, I mean, I assume platinum as well. But what else? What about property?
Well, yeah, let's go through a few more ideas. You could buy next year's birthday presents for your children and your grandchildren. And as far as property is concerned, investing in land, property, or doing a home extension or a loft conversion, or your garden, you know, put in a greenhouse. All of these things can be quite chunky amounts. I mean, where it depends, you know, you could easily spend 100,000 on a home extension or more.
So finally, Clive, what about pensions? Because you know, you're talking about not holding cash, not holding bonds. Pension companies, at least in pension funds, at least in Britain, have to hold bonds. It looks to me like they are going to be the ultimate bag holders, which means that if you have a pension, private pension or company pension with a traditional pension fund, you could end up being the bag holder yourself without even realizing it.
Around the world, many pension funds are obliged by government law or by their investor regulations to hold a high percentage of bonds. They have to do that anyway to manage their risks, because if you imagine a pension fund putting 100% of their assets into equities, and then a whole bunch of people retire and say, can you pay us a pension? Those equities happen to be down on that day. They're going to be cashing in a lot more of the equities than they would have liked.
So reduce our exposure to bonds and cash, increase our exposure to physical assets, gold, silver, equities, and possibly even property, or improve our property. That should keep us relatively safe and protect our wealth, relatively speaking.
nobody should think that I'm advocating putting all of your money into one thing or anything in particular. Diversification, and this is your wealth manager talking to you. Diversification is the key because we don't know which way things will play out. I'm just saying I see a scenario where they're not going to play out very well for holds of cash and bonds, but who knows what the world holds in the future. So the more things you've got your money in, the more ways in which you can potentially preserve your wealth.
Clive, thank you very much for all of this. This has been Clive Thompson, former wealth manager with 47 years of experience, still looking at the markets, still checking out what's happening with the bonds and with the governments around the West. Clive, thank you very much indeed for that. I'm Jasmine Birtles. This has been the Tin Hat Money podcast. Nothing in this podcast should be taken as financial advice. It's financial information. Make your own decisions and speak to a financial advisor if you'd like more information. If you enjoyed this podcast, then like, subscribe, share, tell everybody about it, and go and have a look at moneymagpie.com for more information. Thank you and bye.